Hi, I'm Tom Lydon, editor of ETF Trends, here in Chicago at the Morningstar Conference. I'm here with Dodd Kittsley, who's the director of Davis Advisors. Great seeing you, Dodd.
Great seeing you again, Tom.
So let's address active versus passive. I mean, everybody's looking at all the flows that are going into ETFs. You guys are active managers. You know, what gives?
There's a few things going on here. First of all, there's a lot of bad active out there, and characteristics of bad active is being very close to the benchmark, being high fee, not having co-investment with your investors. Those are all things that inevitably are going to lead to underperformance. And we've been at this a long time. The firm's been managing actively, fundamental, bottom up since 1969 formally, and we believe we represent what the characteristics of good active are. It's being benchmark agnostic, high conviction, low turnover, strong co-investment and alignment with your investors. And that's, I think, one of the reasons why investors are fed up, because the average manager is going to underperform, but it's not to say that there's not really good active managers out there.
Well, obviously, with Chris Davis at the helm, Morningstar Manager of the Year many times over. I mean, all the track record that you guys have, but still having the guts to jump into the ETF space, why'd you do that?
Well, it was a natural. First of all, clients asked for it, and when we looked at it, it made a lot of sense to bring time-tested, proven active management in and marry that with a traditional ETF structure and all the benefits that they offer. In my opinion, what we're going to see in 2017 and 2018, the story in the ETF industry is going to be about active. It's going to be the next engine for growth, and we're fortunate to be right at the beginning of that.
Yeah, so we have a 9-year bull market in stocks, really tough to beat the S&P 500. And even some of these smart beta strategies are challenged because that benchmark has performed so well. The idea is eventually tables turn, right?
Without a doubt.
Trends change, it reverts back to the mean.
Yep.
You guys feel that you're positioned pretty well for the coming years.
Very, very well. And in a challenging market, you can often do better by losing less, and omitting all of this, not having to invest in all of the securities in an index, but being able to be very selective, have judgment, that can add a tremendous amount of value, both in good and bad markets, but I think it really comes out in bad markets.
Absolutely. So let's talk briefly about the 3 ETFs that you folks have to offer. Give me the names and the ticker symbols.
Yeah, so the Davis Select US Equity ETF, DUSA, Davis Select Financial ETF, DFNL, and then the Davis Select Worldwide ETF, DWLD.
Yeah, and the financials are important because you have the financial mutual fund. Financials in a rising rate environment, especially in a pro-growth area, tend to do pretty well. I mean, and you've got select names in there too. And when you look at the largest ETF out there, which is XLF, correct? It's what, $26 billion?
It's huge.
Huge. It's another way to diversify within that sector, but get specific selections and some securities that you at Davis really like.
Being selective in the financial industry is more important than anywhere else, arguably, because it is such a diverse industry in sector. And ironically, we have 25 stocks in our DFNL. Compare that to the index or XLF at 65 or 64. It appears a lot more concentrated, but in reality, it offers broader diversification because there's less concentration in the top in big money center banks.
Gotcha. Excellent. Dodd, as always, I learned something. Great seeing you.
Great seeing you too. Thanks for having us, Tom.